Just going to hop over onto the gold chart. Bear with me a moment. There's something that was quite interesting over there as well. There we are. Okay, let's just pop that up. And again, this is, I just want to pop this up. This is on the 2-minute chart for gold. And it's exactly the same principle. It's really looking at the breakaway opportunities that will deliver something in these markets, in these congested markets. What you're looking for the whole time, if you have to trade them, and not everybody does, because a lot of traders don't feel comfortable trading these very fast time frames. But if you are or congestion, yeah, a lot of traders don't like trading congestion. But if you're going to trade congestion, it's perfectly feasible. You just have to be very light on your feet, very quick, in and out, grab and tag, grab and tag. That's really all you're doing. You're in and out all day long. A lot of traders enjoy it. A lot of traders don't enjoy it. You have to find what you're comfortable with. And this is just an example. You know, you've got gold, which has been, in terms of where we are on the sort of broad picture for gold, we're still bullish gold, have been for a while. On the sort of, this is the daily chart on the daily picture for gold, trading around the volume point of control. We had a very, very strong level here. This was a key level, very significant, at 17.40 an ounce. That was breached the other day. We're now getting up through this region here, which is less significant, but it's capped off the gains. It stopped it at 17.80. And for gold, the key level as a psychological level and also as a pretty much a technical level is really 1800 and there or thereabouts, because once it gets through that level, it's free and clear. And you know, we could well start to see it go back towards $1,900, $2,000 an ounce, the highs of whenever it was several years ago. So that's where we are in terms of technical picture. So in terms of a longer term trading perspective, this is exactly the same as a 15-second chart, if you like. You've got the volume point of control here, very little in the way of support below, very strong resistance overhead at the time, which has now obviously become support, resistance building here. And if you were looking for a breakout on a daily chart and potentially down to the weekly chart, but certainly from the daily perspective, if you were looking at for a breakaway, that's what you're looking at. It's back to levels. It's back to that channel that's building around your congestion zone, and the opportunity, you just have to be patient and wait. This has been going on now since, where are we? This is April, this is May, this is June, so we're about to go into July. So this is really 3 or 4 months worth of congestion. It's fine. I'm sure there's a lot of traders out there who are quite happy to be patient, probably investors as well, you know, waiting for this to break to the upside. And once it breaks to the upside, you know, they'll be buying gold, because you've then got a massive congestion phase below, which is going to act as a huge platform of support to any sustained move higher in the longer term. And going right back down onto the 2-minute chart is exactly the same principle. You're breaking away from here, you're looking for high volume, you're looking for injections of volume, you're looking for buying. And what you've got here, you've got this little rally, and if you were, you know, snicking an ounce or two here, and bear in mind, this is a full-size contract, so these are significant numbers. If you're trading an ounce of gold, then you are trading big numbers, I can assure you. You know, it's worth having. So when you start to see this sort of pattern of configuration of price action, you've got an injection, and then you start to see the volume falling away. You know, it's not a good signal. This is not a good signal. You know, the market's trying to rally. Decent volume under there, not huge, nothing like this, of course, but you've got some volume under there, and you've got weakness. So it's a question of being patient. If you're in this, you're prepared to hold through that, that's fine. You've got a platform building underneath, you've got a resistance building overhead. And if it moves through that region, then again, coming back to the volume point of control, you're into a low volume node. Now the trend monitor, as you can see, has transitioned into a darker blue. It's gone to darker red, but now it's come back out into darker blue again. So what it's telling you is, yeah, okay, we've got a bit of a pullback going on here, but for the time being, you know, I still think this is bullish. I'm not seeing a reversal from a primary trend higher, this bit here, into a primary trend lower into bearish. So the trend monitor is just it is the go-to tool for helping to keep you in a trend once it's underway, because it will give you the confidence to hold in, and if you use it in multiple time frames, even more so, because it'll give you the confidence to hold that position, not to be frightened out of the market with losing some profit. Maybe you thought you'd banked it mentally, you thought I've made a few hundred bucks or whatever it is, and then it starts to dwindle and you come from 250 down to 200, and then it's 179 and then 146, and then you panic and you close out, and then at that point the market pauses and starts to go up again or down again, whichever direction you're trading in. And that's what the trend monitor does. It just gives you that. It's a confidence building indicator to help to give you the confidence to stay in, to keep a position live, to try and maximize it. And if you're trading with multiple contracts, then the way to use it, or one way to use it at any rate, is if you're scaling out, you start with 2 or 3 or however many it is. When it changes color, you can say, okay, fine, well, I'm going to bank some, at least I banked some profit and I feel comfortable with that. And then maybe you leave 1 contract to run or 2 contracts to run, however many you've got. And then at least you are balancing that emotional response of taking some profit out of the market. You feel comfortable because you know you've closed that bit of the trade out. So I've banked that bit. I'm prepared to risk the other bit, but I'm more comfortable in my mind because I know I've taken some profit, and the market can't have that back. And it's one of the ways of trading. It takes experience to learn it and to execute it, because we all start with just trading 1 contract. That's the way everybody starts. You just start with 1. And in the Forex education program, we explain this in great detail, and we also explain how to build up, and the fact that you start with the smallest contract possible and you do it that way. Now, the advantage with certainly in time gone by on the CME, for example, it would be difficult as a new trader, and I wouldn't suggest you did it as a new trader, because if you were trading multiples of full-size contracts, first of all, you need big, deep pockets. Secondly, you are trading large sums of money. But now with the introduction of micro contracts, particularly on the indices, where they trade at 1/10 the size of the full-size contract, it's perfectly feasible, and it becomes, if you like, very much like in the Forex world, where you have mini lots, you have micro lots. It's exactly the same principle. So you find the smallest contract size imaginable, or available rather, and you trade that, and it's perfectly feasible to start with maybe 2 micro contracts of an ES or a YM, and start in that way, in a very small way, with the smallest contract possible, if you're learning how to either scale in or scale out. You can see how we're flip-flopping around at the moment. We're just pausing, waiting, and we will see. We'll come back to that in a moment. For me, I'll probably go back to Anna at this point. Can I pause there, darling?